for Christopher Griffith to join us momentarily. Hey, everybody, it's Hammer. I am here to welcome you all for our Vetted VA weekly mortgage rate conversation. Christopher Griffith will be joining us shortly. Nathan is away on vacation down in Disney, whichever Disney is in Florida. So I think it's Disney World. You guys might know. Is it Disneyland or Disney World? Someone from Florida, let us know in the comments. But anyway, thank you for joining me. We're going to go ahead and talk to you guys about what's going on with mortgage rates this week, what we saw happen last week, and what we think will happen moving forward. If you guys have any questions, of course, please go ahead and put them in the chat in the comments, and we'll make sure we answer those for you as we go along. So let's go ahead and start talking about a little bit about what happened last week, why that happened, and then what we think is going to happen this week and why that's going to happen. So first things first, last week, rates did get slightly worse. And for those of you that have been waiting to lock in or been monitoring interest rates, you may have seen that rates got worse towards the end of the week, especially on Friday. Friday was a really rough day for mortgage rates. And the reason that happened was because of the information that came in about inflation. Now, last week, of course, we did have Veterans Day, which was on Thursday. And again, thank you to all of you that are serving and the families and their sacrifices as well. And on Veterans Day, the stocks were open, but the bond market was closed. And what does that mean for mortgage rates? It means that mortgage rates didn't generally change on Thursday, but we did see a big move from Wednesday to Friday. And Friday was a really, really rough day for interest rates. If you were waiting to lock in until the end of the week, you might have spoken to your loan professional and they might have advised you, hey, things are moving, the markets are moving. And that was because of what we saw with inflation. So when Christopher gets on, we can chat a little bit deeper about inflation. But what happened is that we did see prices jumped 6.2% in October, and that was the largest surge of inflation in more than 30 years. Now, we knew that we were going to see inflation because last year, this time, when we do a year-over-year analysis of inflation, COVID was around and the lockdowns were still around and things were very, very quiet in the economy. And now there's much more economic activity. There's a lot more demand. We're also fighting some supply chain issues driving prices up. So we have what we call that base inflation where it was compared over last year. And that was a big jump because last year was down. But we also were up month over month. And that was a little bit more concerning because we've crossed that line now where everybody said, hey, inflation is likely transitory, meaning it's not something that's going to continue long term. We think it's caused because the economy is opening up. The vaccines hit. People are less afraid of COVID. They're getting out there. They're spending again. And the Fed, our central bank, was really the one that kind of brought that dialogue. And they've been using that word transitory a lot. And now they've started to pull back from using that term. They're no longer looking at inflation as transitory. And they expect that it's going to continue on into 2022. So that's a little bit more of a concern as far as interest rates, because inflation generally is going to pressure interest rates to move higher. And we're not going to see jumps necessarily immediately. We don't see big movements, but you do see rates creep up over time. Ah, there he is. Hello, Christopher.
What's happening, man? Sorry, running a little late this morning. Company's kind of got me moving all over the place. So I'm glad y'all are on started on time. So
yeah, we didn't want to lose it with Facebook. If you don't start within that time window, then they'll end the whole cast.
I get it. Extra Firewatch for this guy. No worries. Keep you into it, I'm sure.
So actually, I'm glad that you're here because we're talking about a little bit about inflation and how that drives interest rates up and the inflation numbers that came in last week. And let me ask you just, I know that you're probably sorry to spring this on you, but just casually with you and I chatting, I'm confused because inflation, we know that this is going to be an issue. We've seen it for months, coming back a few months now. Why do you think that markets were so reactionary to this particular inflation reading? Why? Because that's when we saw rates move, was when this inflation number came in high. And again, from my point of view, everybody should already be expecting them to come in high. So do you have any insight on, because you've got a lot of great insight into the markets as well, on why you think that maybe there was a little bit more of a reaction than usual?
I'm going to punt here. Honestly, to tell you the truth, I could just say, obviously, they didn't react the way that everyone thought that they would. We all thought, or a lot of people thought at least, and I usually think of the best of what I hear from other people that know better, right? But they reacted a lot heavier than, things have reacted a lot heavier, I think, than that than initially expected. And that can only mean that they were, or they are seeing things or estimating things that aren't being discussed widely everywhere else yet, would be my guess. I think it's curious. You see I don't want to call it a stock sell-off, but like Musk is even looking for Twitter of course they're going to tell him to sell stock, right?
Like, he had to file that in advance, though. That was a gimmick because he had to file because he's such a large owner, and without having insider trading, I think it's 60 days.
Right. But I mean, it isn't like the conclusion. It isn't like it didn't do what he wanted to do. And you see the amount of other people. So I don't know what the markets are expecting. I never really do. I'm not the crystal ball guy. I think certain leading indicators kind of help you lean one way or the other, but I'm not for sure what caused them to react, or what caused everyone to react a little differently than they thought that they would, even though the number was high, like they expected a high number, right? And is that all they're expecting? I don't think so. But do they think it's going to be worse? That would be my guess.
Yeah, I'll tell you, we talked last Monday about a very strange reaction with rates to the jobs data that we got the week before, and that came in also on a Friday. So the Fridays have been the big movement days when it comes to interest rates lately, and which is always frustrating because it doesn't give you time to really react. As a consumer, you can see rates move, and you may not be able to get in there and lock them in time, and you'll see a little bit of movement. But I put a chart up on the screen. This is inverse of mortgage rates. In other words, this is actually tracking mortgage bonds, which we've talked about in the past. This is the basis for mortgage rates. Lenders are all going to put their margins on top, and that can vary from lender to lender. But the underlying current that's always going to control which direction mortgage rates are headed is going to be the markets. And specifically, it's a particular bond on the bond market called a mortgage-backed security. And what you're seeing here, this high point, this little iceberg and this high point right here, this was the Friday after we got jobs data. And that was a very, very surprising move, because someone like me that's, used to forecasting based on market conditions and the different variables, when we see strong jobs data, that normally points to a condition where mortgage rates are going to creep up a little bit. And, it's instead, we saw a position where jobs data came in strong, and yet we had a little bit of a dip just for a couple of days. We had a little bit of a dip in mortgage rates, and I just was left in a position where you're like, okay, what's going on? How do you try to, make sense of this? And a little cognitive dissonance. It was just what I would expect to happen was not happening based on what variables we were seeing. And then it looks like it snapped back like a rubber band. And last week we saw that snapback. And I think that inflation data was just one of those elements that kind of brought everybody to their senses, like smelling salts, and said, hey, this is not where rates should be headed, mortgage rates or otherwise. We should not be in a position where rates are getting lower. The economic conditions, the strong recovery to the economy, the strong labor market, these are conditions that normally are going to push rates to move higher over time. So we did see that happen last week, and we did see rates kind of return, and they returned back to where they were actually in the end of October. So it's not a big move. And anybody that's out there, if you've got a house that maybe is a new build and you can't lock in an interest rate yet, you don't have to panic. We're not going to see rates jump into the fours, over the next week. That's not going to happen, but you may see these ebbs and flows. But overall, I think we're going to see a little bit of a gradual move as rates start to move higher. And if we had to put them with a number, somewhere in those mid threes is a comfortable, kind of an average, a national average, if you will. And but we're not seeing anything that's going to cause them to jump up, to any crazy number, but we also probably are not going to see them drop down again because of those variables that we've talked about. We've got a strong economy, we've got strong labor recovery, and these are good things. We need to see people out working. We need to see the economy improving again and recovering from the pandemic. But unfortunately, it means that we do see rates, mortgage rates that will creep up a little bit over time. What do you think of that, Christopher?
I think that's better my explanation, certainly, which is probably why we have you on here. Following the markets is generally all that most of us crayon eaters can do. As far as understanding exactly how they're going to move and why and when, all of those things are really, I think, mystery for a lot of people out there, not certainly everyone. But then sometimes you have the market movement in a different direction based off of a certain indicator that's been successful predicting it, or at least leading it right, in the past. And so how and why things are changing, what they're continually going to look like, who knows? For me, man, at the end of the day, for me, what I will say is I see consumers stressed about a lot. I see veterans out there literally for months racking their minds and stressing over the market moving, which may change things an eighth or a quarter of a percent in the interest rate. And not that that's an insignificant thing, but what's significant is that your par with where the market is that day is as aggressive as it can be, right? Because you can't really control the time constraint of it when you're in a 30-day contract, when you have to lock or what you have to do. And so the important part to focus on is that par, where you're at on that day, what you're receiving isn't high or being overcharged, right? Shoot for under par. What does that look like? There are a lot of different things out there that can speak to that, but I see people stress too much about, is the market going to go crazy? Like, are we going to be in 2% higher interest rates than we are today in 6 months? Like, those are the things that I see them freaking out about. And most of the time it's an eighth of a percent, a quarter of a percent. Even in the last couple of years when it rose up a lot, you're still dealing with a percent higher than we are now is still at what is like you're going to get the mailers that say historic low interest rates because, guys, technically we're still there, right? Interest rates are still very aggressive. And so I think the mindset should be, where do I fix our housing costs, right? For acquisition, certain costs may migrate from there with escrows, right? Insurance, taxes, but you want to fix your cost overall. And that's what purchasing and fixing your interest rate does. And I think with where we're at, people shouldn't stress so much about exactly where they're at it. Just focus on par. Where's the market par and how do I make sure that I'm there? Outside of that, it's a crapshoot for us, I think, for the most part.
Yeah. And absolutely. And I think to paraphrase what you just said, not panicking that they're going to see rates jump is important. Nobody wants to take a higher interest rate. No one wants to pay more than they could have in the past. But at the end of the day, you're not going to see those big moves. And I have the CNBC page up just so everybody to recognize, these are headlines, and those headlines are designed to get you to click on them because that way they sell more of this stuff. And this is the ads. And sometimes if you buy into the headlines, it can really stress you out. If you're worried about when this says, rates are slightly down and rates are up and demand is up, and this stuff will really freak you out, especially if you're spending a lot of time looking at it day after day after day. And I would really, suggest everybody listen to what Christopher said and don't stress yourself out, especially if you've got, I see in your vetted VA group, there's a lot of consumers that are getting new homes built, and they may not be closing until February or March of 2022. And the good news is rates are still going to be low. And when we say low, we're talking about in the ranges like we're seeing now, somewhere within those, lower to mid threes, maybe a little bit higher, but they're not going to be 6% or 5%. You're not going to see that kind of movement in interest rates. So
a framer's son, and in the process in the mortgage, like if you're out there and that's you and you're building a home and it's going to be done in 6 months and you're stressing about what your interest rate's going to be in 6 months, what I want to tell you right now is relax. You're literally going to be stressed out about far more important things than that very shortly if you're not already. So focus on those things. The house getting built. You can't control the market.
Absolutely. And during the holidays, it tends to be more volatile. We see more moves kind of up and down because of the trading through the holidays. And yet somebody in February looking back, if they didn't stress out over all that movement, will find that you're generally pretty, seeing rates very similar to what we're seeing now.
Well, here's the reason why. Like, they're fixed in a position. They see things changing that they feel like they need to react to because that's what they're accustomed to, right? As a veteran, their nature, right, is to react directly to something. But how do they do that? What are their options? And they see these extended lock things and I think a lot of people rationally think that, well, maybe I can get ahead of the change if I do this. But what I don't think that is at their understanding of the need to do that at that very moment, that they understand how many people are paid, how many hundreds of thousands of dollars for those lenders to assess that same thing that they're just becoming aware of and model it into their future forecast pricing on those long-term locks. So even then, like, don't stress about it. There's already someone smarter than you there figuring out what your options are going to be. And typically, I think that what you worry about locking into the future isn't much likely to be better than what you're going to encounter the future because of the amount of people there are to make sure of that.
Absolutely. I agree with you 100%. What I'm going to do is throw on the screen just for everybody to feel like they have something that they can keep an eye on that you guys have regular access to. You can watch the yield on the 10-year Treasury, and this is going to give you some insight into which direction rates as a whole are headed. And again, it doesn't mean that if you see the 10-year Treasury move that mortgage rates got better or that they got worse, but it's going to give you an overall trend.
So this is like that red light, green light game, but for rates.
Yeah, but for rates, right? Exactly. So with this, we're looking at the yield, and as the yield goes higher, that's red light. As yield goes higher on the 10-year, that means that mortgage rates are generally going to move in a direction that's going to see them creep up. And again, it doesn't mean just because you see the 10-year go from 1.62, which is this number that we see it at right now, that's the yield. If it goes to 1.65, it doesn't mean, well, mortgage rates are going to go up this amount. Again, they are separate, but it's an overall trend. And in the past, back at the end of October, when we saw rates that were a little bit higher, the 10-year Treasury kind of capped out around 1.7% yield. And that's where a lot of economists and pundits, they see it ending the year somewhere around that same range. They don't really see it going much higher. And again, these are all forecasts, but there's a lot of people out there with a lot of brain power, and they see what drives these things. So as you see this 10-year Treasury yield kind of creep up, that gives you some insight that maybe mortgage rates are also going to creep up a little bit. But as long as it stays below that 1.7 mark, there's nothing to get alarmed about. You may have seen, rates that were slightly better on a particular day. And when we talk about rates, not only the interest rate, but for consumers, what you guys may not understand is that there's basically it moves in blocks, and you see that a lot of times in eighths of a point. So you'll see 3% and then 3.125 and then 3.250, 3.375. And that's the large movement in interest rate. And then within that interest rate, we have a smaller movement that you get towards your credit, towards your closing costs, or the closing costs that it's going to cost you to go ahead and get a particular rate. And that's kind of where you'll see those day-to-day moves. And you generally don't see anything more than maybe rates jump that eighth of a point. They go from 3 to 3.125. But you'll see where they stay at 3.125 for a few days in a row, and there might be some movement within those on that other pricing. And that's the general movement to them. They're more subtle. Rates move more subtly, and you don't have to worry about seeing these big jumps. So generally, as a whole.
We need to come up with like a list of general rule of thumbs to follow on locking. Like how many of them there are as a general rule of thumb. I've never really liked locking on Mondays or Fridays. It's never really worked for me when I have. Mondays and Fridays for me are not my favorite lock days, never have been. So if you want another general rule of thumb, that'll drive their loan officers nuts, right? Well, I don't know about Fridays and Mondays. I don't know. Some dude with a beard said generally. There are a lot of different things, guys and gals, that are going to determine where you end up in that scale, what changes daily, your credit, your costs, and that sort of thing. That's why it's important when you shop for a mortgage, which is what we always advocate here, that you shop on the same day and time pricing. Get it as close to the exact same apples to apples comparison as you can, because then you'll see how they differentiate themselves with their offering to you, right? Because of the loan estimate and what it declares that they must show you, right? Or a fees worksheet, if that's what they give you, depending on what they give you to shop their charges and their fee structures. So that's the biggest thing. Understand how to shop, how to make sure you know what par looks like through shopping, right? If there's one general rule of thumb I'll tell you too, is every single one of you overpay because you don't shop. And that's not me saying it. It's the data. It's like, I think the NBA said it, like Fannie said it, like all of the big head poncho
Consumer Financial Protection Bureau said.
Yeah, there's a big one. Shout out to the CFPB for hollering at the consumers and telling them, hey, y'all need to shop, because it's true. You save when you shop. There are certain things that allow lenders to compete or cause them to compete more, and they're able to, and they should be competing for your business. It should be a competition for your business. So make them compete by shopping.
Yep, absolutely.
I'm making a lot of loan officers happy this morning. Fridays, Mondays, shopping. What else can we cover?
Yeah, what else can you always ask about your rates and fees and see your LE?
Right.
So, well, is there anything else that you wanted to chat about today?
What's happening the rest of the week and next? Like, what's going to happen?
Yeah, so for the rest of this week, we don't have a lot of economic data. The big day for data is actually tomorrow. We have a lot of housing data that comes out, and but housing data doesn't generally move the interest rate markets. It just tells us how the housing market is doing. And all of y'all that are out there looking at houses know that we've got a very strong housing market, shortage of inventory right now, and that's not changing anytime soon. And I hear a lot of concern about housing bubbles. And we've talked about this in the past, but for anybody that this might be your first time watching, you don't really need to concern yourself that we're in a housing bubble, because there's very different environmental factors this time around. And the big ones being that everybody that owns a house has a lot of equity, and they have the ability to make the payments on it. And those are the two simplest ways to put why we're not in a housing bubble. There's a big supply or a big demand and not enough supply. And the people that have the houses are making the payments, and that's going to keep things away from being a housing bubble. So this week, we don't have to worry about economic data per se. We have to worry about a little bit about that market sentiment. If I shift back on the chart here, you can see that we've lost a lot of ground since last Friday. I have this yellow line here. This is the lowest point that we saw mortgage bonds, which means it was basically about the highest rates that we saw this year. And we're coming near that point again. And we're going to be looking to see if we get a bounce and a little bit of a recovery from there, or if we break below that number. If we break below that, that's a sign that we might see rates move another eighth or even 0.25% over the rest of the month. But as long as we see a little bit of a recovery there, or at least see things slow down in the markets, which is what I think is going to happen, then we're likely to see rates kind of stay in this range where we've seen where they're at right now. Similar to where they were at the end of October, and things should settle in. So we're watching that momentum this week. We don't have a lot of economic data. There's really nothing big going on in the headlines that we have to worry about. There's some new stuff being signed, like Biden will sign that infrastructure bill, but that doesn't have anything that's going to affect mortgage rates and pricing in it that we have to worry about. There's nothing going on.
Did you read it? How do you know that? First of all, did you read it?
I did not read the entire thing. I'm sure it's got lots of stuff, but the reason that I know is because we're not borrowing money to pay for that one. And that's the big thing. Yeah. We're just going to tax some invisible force, but that's another conversation.
Easy. We stay away from all of those things on there. We stick to the economic side of it. But economically speaking, borrowing the money, if we're borrowing it or we're creating it, that adds to that I word, inflation, right?
Yeah.
To a degree. And that helps to encounter some of the things that you inform everybody on. So I would say in general, from your forecast, then, if those of you are out there looking to close by Christmas, be closed by Christmas and moved in, you're probably right within that realm. It sounds like you're going to have some smooth selling here. Nothing too crazy. So don't super freak out about, oh, the mortgage market's changing and I have to decide. No, you have to shop. How many times have I said that so far, Hammer? Shop.
Yep.
I really hope that y'all are getting the point across, all like 7 of you that watch this, that you need to shop. It's the fastest way that you will save money on something you're going to have for a very long time. And it's going to cost you a lot by its own existence, but it will make you more, especially if you make sure that your financing instrument is efficient by what, Hammer?
By shopping. So, and I'll tell you this time around, anybody that is closing soon, if you're going to be closing in the next couple of weeks, before the holidays or before the end of the month, then I wouldn't hold out looking for a better interest rate. If you see what, if you like what you've got on there now, the current market conditions are that it's a good time to lock in and grab that, because you're going to need to lock in. If you close sometime before the end of the month, you're going to need to lock in and give time for all the paperwork to process. You're going to look to do that sooner than later. But if you've got more time on your hands, like I said, there's nothing to worry about.
There you go. If you're hunting for a rate, Hammer's advice for your ROE for the next 2 weeks is to lock them if you got them, shoot them if you see them. Take down the rate that you know that accomplishes your circumstances and fixes that housing cost so that you can begin to accumulate that equity, because that's the nature of what you're doing with purchasing a home. So solid advice. I think good forecast. You got anything else for them? Any other parting shots, save rounds? Anything fun happening?
That's it. No, just hopefully everybody's getting ready for the holidays, and maybe it's a little bit more of a normal one where we get to go out and see each other a little bit. So hopefully that'll be fun.
I think for everybody, I think I saw California posting some regulations on Thanksgiving again or something, but for the most part, hopefully everyone gets to enjoy one of those super expensive birds on some super expensive fuel and hang out in the house because it's cheap at least, and have, ironically then, some family time. So
Absolutely.
Thanks for coming on and checking out everything, guys. Hammer, thanks for coming on and informing everyone. As you always do, if y'all have questions on this stuff, comment below. Ask your questions. We'll make sure that we get them answered by a person who is capable and able to do so. Blessings, y'all.
Take care, everybody.